Ashley had asked me, or Kevin and I, to talk about geopolitical current events that affect the market, the economy. I think, as everybody knows, we have had several fairly important geopolitical events this year. ISIS is killing whipsaw on oil prices, which I'll get back to in a minute. Ukraine, China's economy slowing. Everybody remembers the old BRIC acronym. Well, the B and the R are not doing very well at all, and C's not real good either. India's about the only one that's showing any expansion, and they had a fit of capitalism and removed some government problems that are helping India a little bit. There are several factors that are affecting the economy other than just geopolitical. One of them is the Fed. And by the time we get out today, we'll know what Janet Yellen is going to do with interest rates. The market, way more than the economy, has been on a sugar high since '08. A lot of people think that stock prices would not be as high without Fed basically throwing money out the helicopter. I would disagree in some aspects in that prices for equity are not out of line. Earnings are extremely good for corporations. Their balance sheets are pristine. They're going out and raising debt at ultra low levels whether they need it or not, and just improving their balance sheet. So there's always two sides to geopolitical events. I've never not known an economy that didn't have them. How long has it been since anybody in the Middle East was not shooting each other? Probably since the Shah fell. And before that, I just didn't pay attention to it. But
Big question. You said the equities are not out of alignment or not out of line. Do you measure that from a PE point of view? Is it market cap? Is it
both. Also realize when people are talking about the Dow or the S&P not over price, they're talking about an index. Kevin and I don't buy indexes, we buy stock. And we buy companies that we feel are priced correctly. But the S&P forward-looking is about 15 and a half PE, which corresponds to a little less than a 5% return. Well, in a 2 3/4% interest rate market, that's historically way more than the risk that you have to add for equity. So in my mind, they're, I won't say underpriced, but they're sure not overpriced. Now, when the Fed starts raising interest rates, we'll see. Of course, as anything else, that will affect some parts of the market more or less than others. But in my opinion, the S&P 500 is not overpriced. There are stocks that are. Just don't buy them.
Would you take that same view for REITs and MLPs as well?
Some. Now, geopolitical risk. This is the S&P since 1900 to now. Everybody knows the turmoil we've had here. You go into a 10-year holding period, there's a lot of 10-year holding period, a lot of volatility. That chart looks fairly nice. And I was not there when this happened, but I did hear about it. So, and then, you know, we've got the 66, 74, the inflation with no growth, stagflation. Paul Volcker and came in, and this is probably Paul Volcker right here, where he raised interest rates, but he killed inflation. Ronald Reagan cut taxes, and we were off to the races. And as much as I hate to see it, the leg right before 2000, Bill Clinton did a good job. Don't let anybody know I said that. So if you look at longer term, geopolitical events do not affect the market. The market will adjust to anything if you give it time. So you don't need to worry about, oh gosh, do I need to go to cash? Market's gonna crash next Thursday, 1:15. Anybody tells you that, stay away from it. Getting back a little closer to the economy, not the stock market, but the first quarter was horrible. We had a negative 2.1 or 2% loss in GDP. There were some geopolitical events there, but I think most of it was weather. Because when the second quarter rolled around, weather improved, spending picked up. We had a 4.2% growth rate in the second quarter on second revision. And from what I'm reading, it may tick up another point or two in gain. Some of that's inventory building. When consumers went back into the market, businesses had restocked. And for the first time since the crash, businesses are starting to invest in capital. And when businesses start investing in capital, that's the last leg of the economy. It drives demand for commodities, which have been weak for a while since China's slowed down. But we've seen several things that have given us good hope. Copper prices 2 weeks ago jumped 3.3% in 1 week. Well, China buys 40% of the world's copper. And basically they like to play the market. When it's high, they draw their inventories down. When it falls, they buy back. Well, they started buying back. Also, bulk shipping rates, what's referred to as the Baltic Dry Index, has eased up, which means ocean shipping is increasing, which means the world in general is growing a little bit. The world is not growing as fast as we are, but they are growing overall. The biggest factor that worries me about the economy right now is the slow wage growth. If you go back to the Great Recession to now, the people above the bottom 20% and below the top 20%, that big block of where all of us are, has lost money to inflation. Their wages have not kept up with inflation. People are starting to have more and more trouble keeping consumer spending up, which is 2/3 of our economy, which is one reason I'm glad to see businesses start to spend to help do that. Some of us were talking before the lunch started. There's slack in the labor market according to the Fed. The problem is the slack's in people who have useless education. We need engineers, we need computer people, we need welders, electricians, pipe fitters. These are $70,000, $80,000 a year jobs. Nobody wants to do it because they can draw welfare. And they've got $240,000 of student debt, and the only thing they had to learn for their job was do you want fries? Because it's a useless degree. It was supposed to be a joke. Y'all weren't paying attention.
There was something scary last night I saw on CNBC that the state, it was in Chicago, in the state of Illinois, for the first time ever, welfare recipients outnumber job growth and job creation.
They also
Staggering.
They also make more money than the average salary for middle class in that.
When you're done, I'd like to come back and I'd be curious about the student loan discussions.
Okay.
Later into the end.
Now, we're talking about, Kevin and I always say, and I write a monthly market comment. Any of y'all want it, ask Ashley or anybody at BSG&L, and I'll put you on the distribution list. My last paragraph has never changed. BSG&L is a long-term investor. We believe in investing in profitable companies that are going to grow for the long term. Now, let's look at holding periods. Getting back to my comment earlier about people that are worried about next Tuesday at 1:15. If you your time horizon is 1 year, since 1950 to now, and you invested in an index. That's the only thing you can measure. If you don't measure the index, you're measuring the stock picker, and that's useless. You went from a 51% gain to a 37% loss, 1 year holding period. Bonds, 43 to -8, and the last one here is a blended portfolio of 50-50. And Kevin's going to talk more in that area a little bit later. 5 year holding period. Your gains are less, but your volatility is much lower. And you've only got 2% losses down here if you hold for 5 years. 10 years, it even gets better. And in 20 years, you never had a loss. Jeremy Siegel, professor at Wharton, has wrote a book called Stocks for the Long Haul. And he tracked the Dow from 1802 to 1997 when he wrote the book. And even if you had bought at the high mark on the Friday before Black Monday, and you held the Dow for 20 years, you made money. There's never been a 20-year holding period that you didn't make money in stock. Now, everybody said, well, I don't have, I'm retired. Are you going to live 20 years? So you need some money in stock. Kevin, I don't think we have the two portfolios that's all equity or all bonds. We believe in a blend and putting a portfolio together that where you get back to the blended rate of return. There's less volatility, in which, when I say risk, I'm not talking about buying Enron. I'm talking about up or down year on your portfolio. That volatility is my risk measurement. The biggest driver in the last 7-8 years has been the absolute explosion in hydrocarbon production in the United States. Professor Economides, before he passed away from U of H, wrote a book that basically said the reason we have the standard of living we have and the reason there is a middle class in the world is relatively cheap energy. Energy drives just about everything out there. The hydrocarbon explosion has driven our gas. Oil is a worldwide market. You can put oil on a tanker and ship it anywhere in the world. Natural gas is more stranded. It's more local. You can ship it anywhere you can get a pipeline to, real easy. LNG will help, but it's expensive. It costs approximately $6.50 a million BTU to liquefy, transport, and regasified gas going to Europe, let alone Asia.
Say that again, $6?
$6.50 a million. Well, right now you can buy that gas here for $3.97 before we came in here. So, I don't think our gas will ever get above 6.5, because Europe's paying 12 something. They're not going to pay more to get our gas unless they're really mad at Putin, which they may be. But I don't think it's going to be enough that we can go up $7, $8, $9 for a million BTU until ship it to Europe. So when that falls off, you're going to have a drop in LNG exports. The tremendous increase in natural gas has also brought something else, natural gas liquids. Propane, butane, ethane, natural gasoline, condensate. Y'all probably read articles where Enterprise and Pioneer have gotten permission to export condensate. Condensate is a gas below ground and a liquid above ground. It's almost gasoline. It's very, very light. API says anything with specific gravity lower than 50 is light. That stuff's 38, 39, 40. It's so light that a lot of refiners are having trouble refining it. You can blend it with heavier crude, to go into your process. But about 10 years ago, we had no light sweet crude in the United States. All the refiners went in and added a lot of capital, several $100 billion, so they could handle heavy sour crude from Venezuela, Mexico, and Saudi Arabia. Canada. Well, guess what? We can't get it from Canada anymore, or very little. And Venezuela's a basket case. And you get a little bit, but we're to the point right now where our refineries are what's called a refinery wall. They can't handle any more light sweet crude. We're still importing 7 million barrels a day, and it's all heavy sour crude. If there's only two things that can happen here, we're going to stop slow drilling to raise prices back. You can either export oil, which I don't think politically will happen, or refiners are going to have to reinvest capital where they need more light sweet crude. They're doing that, but they're not adding capacity as fast as we're adding oil. But
GLO CPAs.
what has happened is the gas liquids have really lowered the cost for chemical production. Ethane probably makes 85% of the world's chemicals. You can get ethylene from either naphtha or ethane coming out of the ground. Well, ethane is based on natural gas prices, naphtha is based on oil prices. So companies are shutting down chemical plants all over the world, moving them to Gulf Coast, basically. Between Baton Rouge and Corpus, there's $200 billion with a chemical plant expansion going on. Now,
Say that once again.
between Baton Rouge and Corpus, there's $200 billion worth of chemical plant expansion going on. And that's Westlake, Lyondell, Basil, Dow, Huntsman. These people are shutting down plants overseas. Matter of fact, Dow shut down a plant in Indonesia and is moving the plant, which I would have thought been more expensive than Nuvo, but I guess they don't think so. But this is going to be one of the largest generators of foreign revenue that we have. Right now, we're exporting about 3.5 million barrels a day of refined product, gasoline, diesel, jet fuel. Very little gasoline. The rest of the world uses diesel. We use gasoline. So we're exporting diesel and importing gasoline, but such is life. Some of the people that will take advantage of this are the midstream people as well as the chemical companies. Enterprise Products and Kinder Morgan are building huge pipelines, huge facilities to take the gas liquids that come out of the ground, take ethane, make ethylene out of it. And now they're starting to take propane, butane, and making butyl alcohol and a few other things. This is going to give us a huge cost advantage over time. Probably, I don't think it'll probably be 20, 25 years. Hold on, I got ahead of myself. We're also starting to see methanol. Now, you know, years and years and years and years ago, all us IndyCar racers, IndyCar ran on methanol, which some of us would call wood grain alcohol, rubbing alcohol, like you see in your store. It's made out of natural gas. Natural gas is the fuel, and natural gas is the energy, which makes methanol extremely cheap to make here in the United States. Then methanol is then used as a feedstock to make carpet, furniture covers, things of that nature that you don't use ethylene for. Now, I think we're at the point where Mr. Lonergan can get up here and y'all have to wake up now. Oh, did you want to ask a question about education?
We'll do it at the end of the student.
Okay.
Thank you, yes.
Yes, thank you, that was good.
Thank you.
This is the first test to see whether or not you remember seeing this slide when it was up before. But it kind of goes against the attitude that you hear and see every night on the news about how the world's coming to an end and the next crisis that's out on the horizon, that if you just hang loose and stay in the market for a long enough time frame, everything works out. We've not had a catastrophe where everything went to hell and stayed to hell for a very long period of time. It turns around. There's too much value in the securities, the equities, the fixed income instruments that you have, as long as you're adequately diversified and you don't bet the ranch on Enron. Don't do that. It's not a good
Yeah,
idea.
we don't recommend it.
Right. The other thing that argues
Question,
against,
please. Kevin, you and
Yes,
Ben view these cycles in 20-year increments? Is that generally what we're hearing
the
you
number
say?
that's thrown out there, 18 years,
Okay.
but yes, you can see that at least since 1900. Nobody's gone back into the 1800s, and you could even argue how relevant is 1900 compared to 1960 and 1980, but just as a picture, yes, you can see that there are periods of plateauing and there are periods of very good growth. And it would appear that right now we're near the end of what might be another 16 to 18-year period of more or less a plateauing in the markets.
Those are indexes when you're talking about that time frame. When Kevin and I look at individual positions, we want to buy a company that we feel has 3 to 5 years of superiority where we can buy it and hold it. We don't trade. We try to
So
buy
long-term to
companies.
you is 3 to 5 years?
Yeah,
Okay.
That's the initial period. We'd love to hold it 20 years.
Correct.
As long as each time
Correct.
we look at it, the next 3 to 5 seems to us to be very positive for that company and their outlook. Again, arguing against paying attention to headlines, and maybe is an instance where it's good for you to stick your head in the sand and not know anything about what's going on, would be this analysis that we also showed, where all the volatility that is fodder for the headlines is all around what's happening in a 1-year period. You get out into a 5 and a 10-year period for a measurement purpose, there's not near the volatility, and there's nowhere near all of the catastrophic losses from someone's portfolio. So it just illustrates that if you're not totally focused on just the 1-year horizon and what may be a high or a potential low in a given 1 year for stocks, bonds, or in a blended portfolio, it's time in the market, not timing the market. Ben and I are not presumptuous enough to think that we can't time the market. We know better than that.
that's right.
Okay, this is just a small analysis to kind of blow our horn, but to also indicate that we're not just wishfully thinking when we talk to clients and potential clients. This is actually a client portfolio. He's a retiree. It's set up to be able to generate a distribution from the portfolio. It was set up initially, they were going to need a 5% distribution rate to cover their expenses. Few extras have come along. They've actually, over this 10-year period, they've averaged a 6% distribution out of the portfolio. They have paid 0.8% in advisor fees, and over a 10-year period, they've managed to average 1.6% growth per year for that 10-year period. And you can see in the middle of the chart, April 08 through May of 09, or March of 09, they incurred a 14% loss overall in their portfolio. Our portfolios are not immune to market activity.
Kevin, remind them that 1.6 is over the distribution.
Right, that's the ending value of the portfolio from beginning to end. So after you take out 6% for a distribution and 0.8% for a management fee, it's still growing 1.6%. That is our intention when we structure a portfolio with a client to generate a distribution rate, that we're still growing the portfolio so that this 6% each year can grow to a larger amount to cover inflation. But if we keep taking 6% off of a growing balance, they keep getting a little more each year and can keep buying the same things they bought the year before with a lower inflation rate. But like I say, and what generally does happen if you look at some of those V's, the worst thing you can do in a market downturn is get out of the market and wait till it comes back. Because it comes back quicker than everybody says. It came back the next year, so they were up 16%. And I don't know how many people I talk to who even now tell me they're still waiting to get back in the market. They just don't trust the market. They think it's too high. So maybe someday it'll be low enough for them again to get back in. But if you stop and ask yourself, you know, they'd have to admit that the last time it was that low, they were too scared to get in. And the same thing will happen next time it gets that low. It's always easy to tell yourself, I'll get in the next time it gets low, but then nobody ever does it. It gets low and then they get scared again, so they won't get in.
So Kevin, if we were invested with you, a reasonable expectation that you'd have for each client would be that 8% a year?
Yes,
range?
if they're not structured as a distribution portfolio retiree type client, we sit down and show them that our expectation is a 6 to 8% annual average, and it's never going to be 6 to 8. It's
You're
going to
confident
be
of that?
10. We are confident. Yes, we do not guarantee that, but yes, we're confident that
It depends on the market though, Bob, because
it's an average.
as he showed you, we got our butts kicked in a way.
I'm aware of
Give
that.
it time.
Kevin, I don't know if you said it this time and I missed it, but it's after, this is the 1.6% growth after distributions and after the fees. I don't know if you
Correct.
said after the fees too.
Right.
But anyway,
Right,
yeah.
yes, that's the net when we're measuring the end of the year
Still,
It's an
value.
8.6 return.
After you took all the money out. and paid
Correct.
fees.
After we put all those negative numbers in there, those deductions, it still grew at an average of 1.6% a year. Okay, this, I guess, doesn't look as good on the big screen as it does on the computer screen. Anyhow, this was just a little bit of trying to illustrate when your retirement plan in the middle, things that you have control of, things you don't have control of. Starting with, you have total control over the amount of portfolio risk you take. Talks about asset allocation, where do you invest your portfolio. And you have total control out of deciding how much you're going to save to go into your portfolio and how much you're going to spend. Okay, the two items that are some control are listed as your longevity and basically your employment. You have at least some control over deciding to have employment, but at some point some employers will exercise control over you. Two things that are out of your control are the market returns and policies regarding taxation, savings, and entitlements. And those are probably the two things that you see in headlines way more than anything else. And personal opinion, all it does is cause people heartache and consternation. They shouldn't listen to it. They shouldn't worry about it. It just is what it is, and just take it with a grain of salt. But not many people have my attitude, so you know, I'm okay with it, and I wish it for you guys. So, but anyhow, you know, don't fret over the stuff you can't control. It's going to have an impact on your portfolio. You saw that scale that yes, there are V's in the cycles where your portfolio value is going to drop. It doesn't keep going up every day that you check it, but it will come back. Go on vacation for 2 years and everything will be fine when you come back. As you get 10 years older, between 45 and 54, you can expect to spend another 40% more per year in healthcare costs. If you you add another 10 years out to between 55 and 64, you'll actually be paying double what you were paying in your mid-30s to mid-40s. Between 65 and 74, they say you'll be paying 3.1 times what you're paying as a middle-aged person. And in excess of age 75, the projections, which is it's all they are, projections, which are saying over 5 times what you were spending. So recognizing that not everybody's health is the same, this is just averages of all sorts of people. If you use your own personal 35 to 44 expenditures as your baseline, there's some quick extrapolating you can do to try and help you figure out your retiree budgets and how much you should be making sure you've saved to generate annual income once you hit retirement. So Dr. Stinson, once you do your calculation, you may want to go back to teaching again or decide you got to do something else. Okay, so just some ideas that the impact on the markets, the retirement of baby boomers combined with low investment spending sets a stage for slower economic growth. To some extent, slow and long may be just as good as high and fast. Investors should not rely solely on traditional fixed income for the income due to their exposure to interest rates. Even, I didn't mention it, even in our retiree portfolio that we work with, when we're generating income, we still have between 25 and 35% allocated to equities. It is not 100% fixed income. We still want, like we say, some growth to be occurring in the portfolio to allow us to increase our distributions. And then slower potential growth in the U.S. suggests that investors take a closer look at investments in less constrained economies. Even though we may be the best economy from a standpoint of purely economic growth and financial return, the U.S. stock market isn't the only game in town and isn't necessarily the best game in town as far as making some investments.